All right, so today I wanted to talk about a company that I've never talked about before, and I should preface this with saying that I started buying this in part due to I'm selling, or I have sold most of my position in ATD, or Alimentation Couche-Tard. So getting right into it here, first things first, if you get value out of the video, please like and subscribe. Check out those links below. So this is MEQ.TO, Main Street Equity Corp. Like I said, I sold my position in ATD because if you go back 2 or 3 years, they're not even growing. And the stock is still in a downtrend. So until those things change, I don't think that they're worth the investment. And it's not that I think they're a bad company necessarily. I just think there's better options, right? And this is something that you want to think of when it comes to investing, is that if you know of a company, that, let's say, 2 companies you're comparing, and one of them is clearly better, and they're in a similar industry, I don't see why you would buy both of them. To me, it makes no sense not to just double down on the better one. So MEQ.TO, like I said, is the ticker symbol. They're about a $1.8 billion company. So again, small for world standards, but for Canadian standards, that's still probably not large by any means, but still a decent size. They do pay a very small dividend, 4.74% FFO yield, 13.77% earnings yield. So MEQ, Main Street Equity, is a real estate company which engages in the acquisition, redevelopment, repositioning, and management of mid-market rental apartment buildings, headquartered in Calgary. Focus on the acquisition, redevelopment, and repositioning and management of mid-market rental apartment buildings in Western Canada. Owns properties in 6 markets: BC, Vancouver, Vancouver Island, the Okanagan, and northern BC, Calgary, as well as some suburbs within Calgary, Edmonton, as well as some suburbs within Edmonton, Saskatoon, Regina, and Winnipeg. So again, the first thing that I notice here is 2 things. Number one, they're exposed to the Canadian real estate industry, which, if they had exposure to, let's say, just like Vancouver, Toronto, places like that, I don't think I would be interested. But the thing that makes me really interested is where their properties are located. If you look at the places in Canada where people have the highest standard of living, if I were to name the top 3 provinces in order, it's Alberta, it's Saskatchewan, and it's BC. Some people might try and put BC above Saskatchewan, but Alberta is the clear number 1. So that's why I like them. Their properties are in the areas of Canada with the higher standards of living. So that's the thing I really like. And the reason that I bring up Toronto and Vancouver is the Canadian real estate industry in those areas is pretty frothy. But within Alberta, it's really not. I mean, some people would say Calgary, and I think to some degree maybe you could argue that, but I don't think the apartment industry in Calgary is that bad. I mean, in Edmonton, entry-level single-family houses are still going for, $500,000, maybe $550,000 on the low end. In Vancouver, Toronto, those are, $1 million, $1.5 million. Calgary, they're maybe, I don't know, $750,000, $800,000. I don't even know what the prices are there, but I'm more familiar with the Edmonton area. But I mean, if you look at Edmonton, I mean, as far as cities, above 1 million people within Canada, Edmonton is clearly the most affordable. And honestly, it probably has arguably the highest standard of living, other than maybe Calgary is the only one that you could even, I think, argue is higher in all of Canada. So what I'm trying to say here is the West is the place to be, right? The West, it has the highest standards of living. So that's the thing that the first thing that really jumps out to me here is I think that they are in the area that is primed for growth. And if we look at its insights here, profitability is good. It's not like absolutely amazing, but it is still good. Management's doing a good job. They are outperforming the S&P over the 3-year, the 5-year, the 10-year. They're outperforming. Financial health is actually not bad, especially for a REIT. That's not bad. Growth is good, right? I'm not concerned about that at all. If we look at, analysts are extremely bullish, and they're currently trading below their 5-year historical price to FFO by a little over 5%. So that's the reason that I'm buying this company right now, is that they're trading below their historical averages. So that's the main reason there. Let's get into its financials here. If we look at its FFO, let's start there because that's pretty much the holy grail here. FFO has grown quite nicely. I mean, if we go back about 10 years or so, I mean, it's went from 34 million to 85. I mean, that's, more than a 2x. And in fact, if you look at like 2015 to 2021, they didn't grow at all. Like the FFO was flat. But if you look at the last 5 years or so, it's up more than double. So that's something to keep in mind. If you look at the actual share price, the share price actually grew a decent amount during this time. So it's kind of surprising. But I mean, the last 4 years, they've more than doubled their FFO. So, and I think that trend probably will continue. Are they going to grow that fast in the future? Probably not. But I do think I do think that trend will continue. If we look at shares outstanding have actually gone down over time, which is obviously good to see. A lot of times with REITs, they will dilute a little bit, but they are not diluting. And I think that the reason for that is something I'll get into soon here. But I also want to touch on their metrics here before. Again, if you look at revenue per share over the last 10 years, they've grown about 12%. Their operating margin is basically flat. Their net margin is actually up 3%. Free cash flow per share is up 11.68%. Diluted shares outstanding is down about 1%. Earnings is up about 15%. If we go 5 years, sorry, not 5 years, the last 5 years, not that 5 years, their earnings is actually up 37%. Shares outstanding is basically flat. Revenue is up 13%. So they're actually growing faster. Their net margin's up 21%. So this company's got a lot more profitable over the last 5 years, which again is one of the many reasons that I like them. And that's obviously a really good thing. So this company's actually grown, and this would probably explain the share price appreciation. But they've been doing better over the last 5 years than the last 10 years, which is always a good sign. The dividend. If we look at the dividend, they pay a very small dividend. It's only 8 basis points, but by the looks of things, they actually just started paying that in 2023, and they did grow it quite nicely going into 2025. So I really hope that they keep growing this dividend. For me, a must-have when it comes to continuing to buy this company, because my position is really small right now, something that's a must-have is that they keep growing this dividend. I'm not saying they have to grow it crazy fast. If they grow it 5-10% per year, I would be happy with that. But that's a must-have for me to keep buying the stock. And the other thing that I wanted to get in here that I briefly touched on, and the last thing I wanted to bring up, is the insider ownership. The insider ownership of this company is about 49%, which is pretty much, that probably is the highest that I've ever seen, to be honest. And that's another thing that I really, really like, is company, like when you have companies, and this is the reason I think they're not really diluting, is when you have insiders that own essentially 50% of the company, it hurts them to dilute, right? I mean, if you look at the people at the top of this company, the vast majority of their net worths are probably in this business. And if they dilute, that's literally them lowering their own net worth. So that's something I really, really like here. And again, when companies have, it's not the companies that don't have high insider ownerships can't be good, or having a higher insider ownership simply makes you good just on its own. But it's one of those things that when you see a company that has good fundamentals, they're growing well, they're clearly making smart financial decisions, and they have the high insider ownership, it's kind of like the icing on the cake. It's that thing that gives you that little bit of extra confidence. And that's what I really like. And another thing here too is that institutional ownership of 19% is pretty high as well. I mean, only 32% of the shares being owned by, retail is pretty low. I mean, there very few stocks or companies will have a retail ownership being that low. So long story short here, I really do like this company. This is one that I probably want to get up to 2 or 3% of my overall portfolio, which obviously will take probably a year or two to do probably. But again, I'm willing to do it because I think they're a really good company. Like I said, the main thing that attracted me to them, number one, is the location of their properties. Number two, that high insider ownership, and number three, or the most important, being the track record, right? The historical track record of having that good growth, right? Like I said, if we compare it to the S&P over the last 10 years, they're up, 467%. The S&P is up 250, so they've almost doubled them. In the last 5 years, they're up 266. The S&P is up about 137. Again, this is including reinvesting dividends. And even the last 3 years, they're basically even. The last 2 years, they're basically even. The last year, they're basically even. So again, to me, there's just nothing not to like here. And even if let's go back like 20 years, just out of curiosity here, they're up 3,800%, and the S&P is up about 600, right? So this is what I really like, right? This is what I really, really like, that they've historically they've outperformed. And again, I think the Canadian real estate industry is a little frothy, but it's specific to Vancouver and Toronto. And again, they do have some Vancouver exposure, but again, these are more apartment buildings. These aren't necessarily single family, right? And I mean, single family is in these cities where the frothiness exists, right? I mean, apartments, yeah, they're still crazy expensive. Don't get me wrong, but it's the single family, it's the townhouses, the duplexes, like those are the places where the most frothiness exists. Again, when you're looking at people moving into these cities, especially newcomers, younger people, because again, these are the people that are most likely to move, right? The people that are most likely to move are immigrants and younger people. And what do those people tend to have in common? They're probably not making as much money as the average, adult that exists in the current area, right? I mean, you take someone who's 50 years old, like a random group of 50-year-olds that have lived in the area their whole life, and you compare them to new immigrants and you compare them to 25-year-olds, well, the 50-year-olds are going to be making a lot more money on average, which again, where the frothiness comes from. The people that are moving in, they're not going to be able to afford as much, and they're going to be the ones more likely to end up in the apartments, which again is good because that's where you got to start sometimes. So I do like that. And again, they also have, the last thing I wanted to bring up here is that they also have some positions in student housing, MacEwan, U of A, NAIT, and Norquest, which again, these are all colleges, universities in Edmonton, which again is one of the most affordable, not that they're affordable technically when you actually think about it, but the most affordable big city in Canada. And again, University of Alberta is one of the top universities in Canada. MacEwan is popular in the area. Even NAIT is one of the most popular of like the trade schools and whatnot. So I like that as well. And not to mention too, that's a way to diversify too, right? It's a good way to diversify. And not only that, a lot of that is guaranteed money. Like it's guaranteed money that like nobody really gets evicted from, you might for partying and stuff like that, but you don't get evicted for not paying your bills. Typically people have that set up ahead of time. So that's kind of what I'm trying to get at there. So anyway, like I said, the last thing I guess I'll touch on is the price target. Again, people are wondering, okay, well, you say you're buying it right now. Where will you buy it until? And for me, that cutoff is simply that 5-year average price to FFO. Not that that's necessarily a perfect number, but it's a really educated guess, right? It's a really educated guess. This company's performed well historically. If it's trading above its historical averages, chances are it's trading at a discount. That's the logic I'm using there. So that's the last thing I'll touch on there. Like I said, if you got value out of the video, please like, subscribe, comment, check out those links below, and stay tuned for more.